The market hype trap. Why your favorite ETF is a money trap. The truth about AI, crypto, and cannabis ETFs. 96% loss over the last 5 years. ProShares Ultra Pro, short QQQ. MJ 87% loss over the last 5 years. Amplify Alternative Harvest ETF MJ. The fund is the first U.S. ETF to target the global cannabis industry. 78% loss over all time. Invesco Solar ETF TAN. 72% loss over the last 5 years. Invesco Wilder Hill Clean Energy ETF, investing in U.S. listed companies involved in cleaner energy and conservation. ARKK 44.76% loss over the last 5 years. ARKK Cathie Woods ETF, investing primarily in companies involved in disruptive innovation, such as artificial intelligence, genomics, and autonomous mobility. 41% loss over the last 5 years. First Trust NASDAQ Clean Edge Green Energy Index Fund, QCLN. The allure of the next big thing. We've all seen the headlines. AI is the new gold rush. Space is the final investment frontier. Blockchain is changing everything. And honestly, it's exciting. When you see a specific sector exploding, it's only natural to want a piece of the action. That's where thematic ETFs, or what I like to call market hype ETFs, come in. They promise to package the future into a neat little ticker symbol you can buy with one click. But here's the cold, hard truth. For most beginners, these funds are less like a rocket ship and more like a money trap. Today, we're looking at the research that shows why investing in what's hot is usually a recipe for underperformance. What exactly is a hype ETF? A standard ETF usually tracks a broad index, like the S&P 500. A market hype ETF does the opposite. It ignores the overall market and zooms in on one narrow, trendy idea. Think of it like this. A broad market fund is the entire grocery store. A thematic ETF is a specialized aisle that only sells pumpkin spice-flavored snacks in October. It's popular for a minute, but it's not exactly a balanced diet. These funds usually launch right when a theme is dominating your social media feed. They concentrate on 20 to 50 similar companies. Because they're so narrow, when the trend is hot, they fly. But when the attention shifts, they crash hard. What the research says, the ouch factor, you don't have to take my word for it. Academic research from professors at Ohio State and Villanova studied these specialized ETFs, and the results were, well, pretty grim. The 4% gap. They found that these funds underperform the broader market by roughly 4% per year. The timing trap. These ETFs are almost always launched when the underlying stocks are already expensive. By the time the fund is available for you to buy, the smart money has already moved on. Retail versus pros. The study also found that institutional investors, the big pros, mostly avoid these products. They're designed to be sold to speculative retail investors who are suffering from a serious case of FOMO, fear of missing out. The hidden cost of storytelling. Now, let's talk about the silent killer of your portfolio, fees. Broad market index funds are incredibly cheap. You can find them with expense ratios as low as 0.03%. Thematic ETFs, they often charge 0.75% or more. That might not sound like much, but let's look at the math. Over 30 years with a $10,000 investment. In a low-cost fund, you could end up with about $74,000. In a thematic ETF with higher fees, you'd end up with roughly $59,000. That's a $14,000 difference. Gone. You paid that money for the privilege of owning a cool-sounding fund that likely underperformed the market anyway. As Vanguard founder John Bogle famously said, slicing the market into tiny pieces turns investing into guesswork. A better and quieter way. So, if we shouldn't chase the hype, what should we do? The experts and the data point to broad, low-cost index ETFs. When you own a total market fund, you already own the AI companies, the clean energy pioneers, and the biotech giants. But you also own the boring companies that actually make money year after year. As financial expert Walter Updegrave puts it, By holding broad funds, you automatically benefit from successful themes as they emerge, without having to predict them in advance. You get the growth of the overall economy without the wild, heart-stopping swings of a single theme bet. Look, I get it. Buying a global robotics and AI fund feels a lot more exciting than buying total stock market index fund. But successful investing isn't supposed to be an adrenaline rush. It's about building retirement security. Market hype ETFs are built to sell a story, not to build your wealth. The bottom line: 1. Avoid the trendy tickers that dominate your newsfeed. 2. Watch out for high fees disguised as innovation. 3. Choose broad, diversified funds for steady, long-term growth. Keep it simple, keep your costs low, and let time do the heavy lifting. I hope this gave you some value today. If it did, a like would mean the world to me and helps others find this content too. Thanks for sticking around. If you enjoyed the vibe here, we'd love to have you in the community. Hit that subscribe button to join us.